So, fun weekend. Welcome back, Dave. I can't recall the last. I think you were on BDE with us, but this is kind of a wheelhouse intersection of geopolitics and I think technical understanding.
Yeah.
So, for those who haven't had the pleasure of seeing Dave on the platform, Dave is currently an adjunct professor of petroleum engineering. Spent about 20 years on Energy Wall Street with Dave. We're former classmates from Texas A&M long ago. Before there was
way back.
Let's just say it was pretty unconventional.
Yep.
And so wanted to talk really after seeing a bunch of what I call instantaneous technical experts popping out of the social media woodwork over the weekend, talking technically about Venezuela and the potential and what that means. I've used the term on BDE when Trump went on his arm twisting tour shortly after inauguration with OPEC. It was ostensibly an investment junket, but we saw the acceleration of restoration of cuts. We've got a president who we've long said is a low oil price president. There's been a lot of consternation over the last year about, he's not been a friend to the industry. And what he cares about, and even on a compounding basis, is what oil prices do and ultimately retail prices do. Certainly heading into November in a midterm when it looked like a slam dunk a year ago, we've got a lot of political risk there. But just given your background in Venezuela and maybe talk a little bit about that before we kick off the discussion.
Yeah, sure. So one, thanks for having me. It's always fun. If my experience in Venezuela goes back to my days at Holditch and Associates. So I was there from 91 to 98 or 99. And at the time, Venezuela, they nationalized in the 70s. They were in the midst of what they called La Apertura, or the opening. So bringing back in foreign investment to partner up with the PDVSA companies, Merivan, Lagavin, and Corporavin. Holditch had a rep, Marcelo Laprea, who I actually co-taught with last semester. PhD, he's Venezuelan. He was living in Venezuela at the time, had some consulting businesses, and he was basically opened the Holditch office in Caracas or in Puerto La Cruz, actually. So we were fairly active in Venezuela with field studies and doing things during La Apertura. It's a resource-rich country for sure, but it's mature resource.
And problematic.
Going forward. So
is it, I was looking at, in my Venezuelan connection, I'm married to someone who was born an expat there. Father was down there in 50s and 60s doing petroleum engineering work all over the country. But, the vantage point that I've had over the last 25 years is primarily as a result of, global macro and what we went through in the early part of the 2000s in terms of really retrofitting the Gulf Coast refining complex when we all thought that's where the growth barrels were going to come from, pre-shale, right? So I think of, just level setting for our audience here, I think of kind of two major 30,000 foot level producing provinces. One is Maracaibo, which was discovered, I believe, in the 40s, and the Orinoco Belt, which is where the vast majority of the, I call them Chavez proved reserves, of the 303 billion barrels that's being tossed around. That's the really kind of complex, unconventional part. Now, not to say that Maracaibo, which is more conventional, doesn't have pressure depletion problems, et cetera, low GOR. What we're focused on here is, at least as we look forward, helping people understand both the above ground and the subsurface complexities and the capital associated with that.
Yeah, I think when you think about Venezuela, so in the 90s, we were working in Mexico with Pemex. We were working with Petronas in Indonesia. We were working with PDVSA. In my opinion, no question, PDVSA was top tier national oil company, because when they hadn't been nationalized that long ago in the 70s, and they nationalized around this structure of Merivend, Corporate, Lagavant. So they kept the IOC framework in place, and that was really important from a technical and operations perspective. They were very, very good, and what they needed with La Petura was a little bit more technology, but really capital.
And a lot of capital.
A lot of capital. When Chavez took power, he, for a number of reasons, gutted PDVSA and mashed those operating entities together, and there was intellectual flight out of Venezuela to other parts of the the region and the globe. And Venezuela had very, very good technical people. So the challenge going forward is you've had 20 years or more of a country that's run their oil field operations with insufficient capital and insufficient technical resource.
Kind of the worst case example of NOCs. I've dealt with some NOCs from Petronas to OGDC in Pakistan to ONGC in India. And they are the more traditional, at least in OGDC and ONGC. And as you would describe Pemex as a comparative, is more of the traditional, a lot of bodies, not really kind of cutting edge technical sophistication and capability. We could do a whole other show on Cantarell and that whole history. But anyway, so we've had, essentially since Chavez took power, we've had more of a typical dysfunctional NOC type leadership, both organizationally and operationally.
Yeah, no question. And so you've got lack of investment in two really key places, both upstream, conventional and heavy oil. The conventional is a problem because it's hard to restart water floods that have been mismanaged, pressure maintenance that's been under pressure supported. You can go in and spend capital there, but you don't get an instantaneous production response. So,
and you're talking about mainly Maracaibo.
I think of, and so it's a little bit, it's in the water. It's not deep water, but it's in a lake. And so that makes it a little bit more challenging. So if you and I were going to go into Venezuela and say, all right, we've got this concession in Maracaibo, there's a lot of field study work that has to be done to understand what's the capital, right? What's the capital? What projects need to be worked on? How do you prioritize it? And then you figure out what the production forecast is going to be. And I think people are they're thinking about this in terms of, oh, it's just easy. Go in there and drill some wells and open the spigot. And
you got a pressure depletion problem.
And the heavy oils, same issues. And then the other facet is the downstream. They've got 1 million barrel a day refining and petrochemical complex that's been massively underinvested in by all reports. And so there's a lot of capital that has to flow both into the upstream and into the downstream sectors. And again, it takes time. You've got to come in and assess what needs to be done here. And I think you talked about the however many billions of barrels of reserves. I mean, be cautious of a political pundit throwing out reserve numbers. Let's call it a resource number. And you don't know if it's a reserve until you get in there and actually spend capital on it and figure out, can we actually produce
so
this?
Let's use the mainstream view of 303 billion barrels. You've got, of the 303, 275 million barrels is Orinoco.
Right.
It's heavy. And the conventional is a sliver, And so we're talking about potential and euphoria based on a very problematic, not only crude assay, but also if you think about the reservoir itself, just the characteristics of the reservoir.
Yeah.
I refreshed my perspective in that, we're dealing from anywhere to 1,000 to 10,000 centipoise viscosity. You've got a real skew to horizontal permeability, which relative to vertical creates sweep issues, sweep efficiency. 1.2 trillion barrels in place in Orinoco, and claiming that 20% is achievable is technically and economically recoverable. I mean, that's the definition of proved reserves, right?
Right.
You got technically recoverable resource, but is it economically feasible is the issue.
Yeah, that's why I call it resource and not reserves. And by the way, just as an aside, you talked about the centipoise. For those who are not technical
TI
geeks,
is what?
This is one. Water is one. TI in the ground is less than one.
Yeah.
Because it's got gas in it, it's at temperature. So to be 0.6 or 0.7. So when you're talking about 1,000 centipoise or more, that is thick, gooey stuff.
And there's also water there in situ that has preferential mobility because of its viscosity profile.
Yes. It's a very challenging, very specialized group of reservoir and production engineers.
It'd be nice if all the world's reservoirs were 1,000 plus millidarcy permeability, right?
Right.
Which they've got. It's just a question of how do I improve the relative mobility of this really heavy oil? And we're talking about 9 to 12 API, right, compared to TI, which is in the 40s, low 40s.
Absolutely. And if you look around the world, the place where you've got probably the most heavy oil production is north of us in Canada. And so if you want to understand what's the capital requirement, what's the technical requirement, you can go look at what they're doing, and it's challenging.
Let's talk about the other crappy stuff that's in the oil. Vanadium, nickel, sulfur.
Yeah.
When you hear of high sulfur oil, you think other things that are challenging from a processing and refining standpoint. You've got to have, enough complexity in the refining system, and the U.S. Gulf Coast has got the highest complexity network in the world by a pretty wide margin. I mean, we designed for that in the retrofit in the late 90s and early 2000s for a lot of reasons related to regulatory compliance, et cetera. And that was billions of dollars of capital. And so, what we've seen is, not surprisingly, a growth over the last 10 or 15 years in imports from Canada, taking the place of diminishing imports from Venezuela.
Right.
Not just Venezuela, but it was well over 1 million barrels a day. And then since Maduro, kind of mid 2010s, and we've got a graph in there to show the split of domestic consumption, imports to other countries, and imports to the U.S. From the EIA, and it paints a pretty stark picture of how that has happened. And so, I mean, what are the primary mechanisms for Orinoco relative to what we see in Canada, which is a lot of thermal?
Didn't do a lot of work in Orinoco, but it's certainly going to have to be steam with those kind of viscosities. It's a high capital cost, and it's a high operating cost environment.
And steam means gas.
Yeah, it means a lot of gas.
So I was doing some research, and it looks like, we're talking about, if we're talking about cold heavy, which is diluent and polymers, naphtha or condensate, you're spiking a barrel with a quarter of a barrel to a third of a barrel of value product. And that's vast majority of the upgrading historically has been. But when you talk about thermal and really putting in thermal operations, you've got gas, which is, I think, 4 BCF a day for 1 million barrels a day. Not trivial. Venezuela produces today something on the order of 6 BCF a day.
Mm-hmm.
And then you've got certainly the cost on the cold side of using surfactants, polymers, diluent, which is further compounded by the fact that you've got sweep problems in the reservoir, both from a steam and any kind of chemical assist in terms of EOR or secondary.
Yeah, it's incredibly complex. It's the opposite of unconventional, right? So there's a niche technical group that'll do that, and a lot of them live in Canada right now. So hopefully they're brushing up on their Spanish. And this isn't a case of you can't grow production in Venezuela. You absolutely can grow production in Venezuela, but be really careful about magnitude and timing, because it takes time to assess, put capital in the ground, and see the results. I mean, this is clearly not a one-year program. I don't know if it's 3 years or 5 years, but assuming companies, fool me once, shame on you, fool me twice, shame on me. Companies have to have some confidence that the fiscal and the political regime is stable enough to come in and sink a bunch of capital. People talk about low prices as an impediment, and it is, no question, but a production sharing contract has more downside price protection than a traditional tax and royalty regime like you see in the US. So there is some comfort because you get your costs back quicker with those production sharing contracts. But what are those contracts? Have they been rewritten? What do they look like? And so there's a lot of non-technical financial and political issues that need to be understood and resolved before you're going to put your technical folks and figure out, okay, what are we going to do here?
Well, the sanctity of those contracts over the last 50 years has been violated a couple of times.
That's right.
And so if you're Exxon, and I think Darren Woods, as recently as November, was commenting on the scenarios in which, a reentry to Venezuela would be at least considered. And then you have this unique animal that U.S. majors are privately held. They're not in any way, shape, or form incentivized or motivated by the state. Now, I have no unique insight into what the commercial landscape assisted by the U.S. administration is going to look like and what type of incentives. But I have to believe with the type of above ground risk right now that we have, everything's opaque. Trump said we're going to be running the country for the meanwhile. What does that mean? If you're looking at sinking billions in capital, which is, we start talking in units of billions, given all the, I think I read somewhere, it's not a question of, you're spending tens of billions just to restore. And a lot of that's obviously infrastructure, both upstream and downstream, before you can think about kind of growing from that baseline.
Mm-hmm. You looked, Schlumberger and Halliburton benefited in the stock market kind of the first day after this was in it.
Yeah, I think Schlumberger was up 8 or 9% on the open.
Yeah, and so that tells you there's going to be, you don't know which companies are going to go in and they're going to spend a lot of money, but you'll have Schlumberger and Halliburton, and the service sector will benefit. The beauty of the service sector is much of their equipment's on wheels, or you put it on a barge and you can get it in the country quickly and you get it out quickly. So if things, go sideways, you can make it. Again, the guys at Schlumberger and Halliburton probably disagree a little bit, but you can make an investment in Venezuela with less downside risk than if you're going to spend an upstream company who's going to spend $1 billion in country, because the only way you get that out is through oil production.
Yeah. And over the last 5 to 10 years, a much more investor prioritized way of behaving for all US based oil and gas companies. There's not a bunch of unallocated capital sitting around today that would inherently, even for the largest of the super majors, would inherently command a big part of the 5-year look on capital budgeting if all of a sudden you decided we're going to make a big pivot and go after restoration and growth opportunities in Venezuela.
Right. That's where low oil prices has an impact is where's my cash flow, right? Companies have been much more disciplined in the last 5 to 10 years than the rest of my lifetime in returns back to investors and shareholders. At $50 or $55, where's the cash flow? If you're going to continue to return to shareholders, what are you not going to do if you're going to pivot into Venezuela?
And discounted from there relative to my wellhead realizations just because of crude quality discounts to start of $15 to $20 a barrel.
Right. And how does what happens to?
I mean, just look at WCS relative to TI.
Right. And then what happens as you grow production? What happens to those differentials over time? And there's a lot that goes into this. Again, I think the message for oil markets needs to be: you can grow production in Venezuela, but it's going to take a while, and you'll see it coming when you see companies engage in new production sharing contracts and when they actually spend capital. Doesn't matter what they put in an investor presentation, is when do they start to spend capital and what are those projects? Then you'll be able to assess, okay, what's the production growth going to look like? And
you and I both know that institutions have had a pretty strong aversion to long cycle versus short cycle as we've been through the last 15 years. And so these are definitively long cycle investment conversations.
Yeah. And the one, if you look and you say, okay, why would you want to go into Venezuela? Well, if my other alternatives for resource capture or exploration, there are very few people who know how to do exploration well globally. So we have this resource. The oil's there. We can argue about how much. We can argue about whether you can get out economically. But much like the unconventional, it's there.
Right.
And so then you can go in and assess, can we make it economic? So the resource capture calculus is a little different than, and that may be attractive to some companies, but I think people are going to be very cautious on how they kind of dip their toe into the investment opportunity.
I think Trump looks at this as another drill baby drill by proxy. I said it was by proxy via OPEC. You and I both know that what's going on out in the Permian is not a story of acceleration as it relates to capital and new permitting and drilling, continuing to be on warm idle here. I think it just goes to show the incentives and the drivers are firmly in the hands of their institutional holders. And so no one's going to, unless the rules change or unless there's some kind of emergency wartime footing program, no one's going to compel these investor-driven entities to willy-nilly just start sending ships and barges and helicopters and everything else you need to get after it.
Right. I think that's spot on. Again, I don't know how you go to your board of directors and say, hey, let's go spend a couple billion in Venezuela. The shareholders aren't going to like it.
I think
shareholders will hate it.
I think a couple of, analogies here or first derivative effects to think about. One's an analogy, one's a second order effect. Is, Venezuela for the last several years has been adopting a more aggressive posture as it relates to Esquiva and Guyana. There's tension out there on the water right next door in Guyana, where Exxon is clearly blowing and going, developing projects, bringing FPSOs online. This, all things equal, I think helps the security situation for certainly Guyana operations. The other analogy is take a look at what has happened or has not happened since Milei came into power in a couple of years ago.
Mm-hmm.
Yeah, Vaca Muerta is a hell of a potential story, and they are growing production. But have we seen reentry in Argentina? Because you have a much more politically aligned administration in power, but have we seen, kind of a big return to Argentina by the super majors? I haven't seen anything.
I don't think so. I think the Vaca Muertas had a bit more attention to it over the last 5 years. It's slow, but there's been technical progression. There's been, Bill Von Gotten does a lot of work down there. They've done some things to move the ball forward, and I don't think that's happened at all in Venezuela. So I think the Argentine analogy is good, but I think there was already acceleration or forward progress there when the new administration took over.
I'm just using that as a kind of political transition, the political landscape post Milei being much more receptive, and you haven't seen it. Venezuela is a haunted house of that stuff at this point. And so the risk calculus that is applied here by an Exxon, Chevron's there and they're the ones that remained, but re-entry for a ConocoPhillips or an Exxon, there's a really different, if Argentina is relatively easy from that dimension, Venezuela is orders of magnitude more difficult, at least at this point. And there's a lot we're not seeing. I'm confident that we're probably not going to see for a while. Again, I go back to Trump blurting out in the press conference, we're going to be running the country for a while. What does that mean? Well, you thought Machado was going to get installed because she's viewed by most as the legitimate winner of the last election. Well, he's got Delcy, who's Maduro's VP. You don't know what kind of back channel deals were made, and where does that all settle out? So in the near to intermediate term, I think the above ground risk has a lot more influence on the pace and enthusiasm with which there's a response. And cynically, I believe that, because there's a lot of jawboning that's going on that has really affected the market's ability to kind of recover here. And I'm talking about oil and gas equities and the crude macro in general. I don't think any of that matters beyond kind of the first order of business, which is making sure we do everything we can to keep the House and the Senate in the midterms this year.
Yeah.
That's a 2 + 2 = 20 leap, but.
No, I think that's, if you look at what OPEC did, and this is a broader conversation, but putting out a production increase schedule for, 16 months or whatever or in early 2025, that's unprecedented. And it was clear I think the administration wants to keep oil prices down till the midterm. And I'm wildly bullish on oil prices beyond the midterms, because if you keep low oil prices, demand's growing globally. My question is where's all this excess oil showing up, right? Where is it?
Mm-hmm.
It's not showing up in a big way in U.S. inventories, and that's typically where it does show up. So if global demand is starting to accelerate into the teeth of all this extra OPEC oil, then once you get past the midterms and OPEC says, yeah, we're not going to increase anymore, I think demand catches up pretty quickly. And now you got a problem, because how much spare capacity do you really have outside of Saudi? Well, how much you have in Saudi, but how much is there outside? And I think the answer is going to be very little.
Permian's not there.
Yeah, Permian's not there. Permian's slowing down. You're consolidating. Rig count's on a slow, steady decline. And growth was going to be hard there anyway. So I think you can run oil prices up really high in 27 and 28. And, I think that's the physical reality of global supply and demand.
Yeah. And probably, we'll get enough mileage out of the euphoria around Venezuela being a quick solution to keep a lid on any kind of upside price action. But I'm as perplexed by the fundamentals disconnected from, what we're seeing in terms of the price action in crude. Where is this massive surplus that we've been talking about, starting with the IEA? 4 million barrels a day. Yeah, demand is strong.
And so I'm going to hop on my soapbox for just a minute on that, because the answer is always, well, China. Okay, so the oil's the one place you can't ever see it. That's a convenient argument. So let's look at Cushing. So the last numbers, and the numbers have to be higher now, but the last numbers in Cushing, if you're going, so this is
what Cushing is.
So Cushing is the biggest small town in Oklahoma. It's where all the pipelines cross, and there's 80 million barrels of crude storage in Cushing, and that's where WTI contract is.
It's a physical
delivery point for the WTI contract. So it's a brownfield expansion. So if you were to do a brownfield expansion at Cushing, where you already have infrastructure, you already have pipelines, 1 million barrels of storage costs $20 million. So $20 a barrel. So if we're over a 2-year period, 1 billion barrels oversupplied, where does that show up? If it doesn't show up in the U.S., tell me which third world country, I almost said third world shithole, which third world country has spent billions of dollars creating storage for that time period when OPEC decides to produce too much. Now, there is a strategic storage element to China, but you got to be really tempered on those volumes, because it's always, anytime there's an oversupply, that's always the go-to.
That's a relief valve.
Yeah, it's always going to Chinese strategic storage. At some point, the numbers become laughable, and if you look at oversupplied periods in time, and you look at OECD stocks, so we look at crude and refined products, the U.S. is roughly, again, these are stale numbers, but 45% of U.S. inventory is 40 to 45% of all OECD inventories. Typically, the U.S., in an oversupplied market, you'll see 80% of that oversupply in the OECD show up in the U.S. So again, which third world country has more available storage than developed Western Europe or developed Asia? It's
where we have the best visibility on measuring those inventories being in, certainly in the U.S., in the OECD.
Yeah. And so why do they, but it's important. Why do they show up in the U.S.? They show up in the U.S. because we have 80 million barrels in Cushing. It's where it's where the physical contracts are closed, right? It's where you trade the physical. And so the U.S., you've got Cushing, you've got a lot of storage in the refining complex on the U.S. Gulf Coast. And it's the absolute overlay of physical and financial. So when the market's in contango, in other words, forward prices are much higher than today, storage owners, nobody's speculating on crude in the future. the contango says, all right, well, I'll buy crude today and I'll forward sell it a year from now and I'll store it and make money. It's just an art.
So we ought to see physical inventories rising much faster in proportion to the kind of chatter that's out there about how much oversupply there is.
Absolutely. I agree that.
Are you saying inventories matter?
Yeah, I think, yeah, Mark. Yeah. It's, so that tells me again, I'm happy to be wrong on this, but I do believe the market's loose, but it's tighter than the headlines would suggest, which means you can work through this surplus very quickly as soon as OPEC quits putting oil on the market.
Yeah, I mean, if Orinoco was shale, you had a bunch of drill-ready locations. That's a much more immediately responsive situation, assuming you've got commercial and geopolitical stability.
Right.
And, you can see a little bit out on the horizon. Your risk premium goes down. I'm going to shift a bunch of capital there in kind of pivot type of time frame. That's just not going to happen. The point is, I think that this was an absolutely perfectly timed, we've got our hands on 303 billion barrels to, have that jawboning or headline pressure to keep things in line and kind of keep the boot on the neck of oil prices relative to what we think is more accurate from a physical supply-demand balance reality standpoint. And if we do get evidence of draws and inventories that are implying, surging demand, the world doesn't have the kind of the toggle to go to in the form of what's happened, the role that the Permian, for example, has played in the last 15 years.
Yeah, and I think so. So what do you watch over the next 18 months, right? So on a global macro perspective, you look at the shape of the forward curve, contango or backwardation. That's telling you something. You watch inventories, particularly in the U.S., where you've got visibility, and then in Venezuela, I think you have to watch. Don't listen to what pundits say.
Watch what they do.
Watch what companies do. Do the PSCs get rewritten? Do companies sign up for said production sharing contracts, and do they start spending capital? And where are they doing it? Those are the easy, and you'll see it because they're going to be public companies, and it'll be.
I did have an Alexander Haig flashback, like I'm in control.
Yeah, I'm in charge here.
But working out all the commercial framework and the legal and contractual stuff is, that is absolutely critical to the way any rational player would look at, again, shifting portfolio and capital allocation for a meaningful period of time. I mean, that in some cases, it turns your 5-year outlook on its head. And CEOs and boards just don't move that fast.
No, and I think if you could say, well, the terms would have to be really favorable to get companies to come in. I think the pushback on that I would have is those terms, the more favorable they are now, the more likely they are to get rewritten 5 years down the road.
Yeah.
And so just because you have a favorable set of terms, I think companies are going to continue to be, again, very cautious. You've got to see stability, and stability takes time. Like you said, the Trump administration say they're running the country. The vice president's the new president. What does this look like 3 months from now? I don't think anybody knows. Well, if you don't know that, how are you going to sign up to invest billions?
It's going to be an interesting State of the Union coming up here in a few weeks, for sure. And I think there's a lot of noise out there, and naturally so, just because of the social media 24/7, 365, 360 degree. I just think that, having at least some foundation into what is the physical and technical reality on the ground, never mind all this other stuff that no one has a really good handle on it. We're left with a lot of questions about how running the country on a short to intermediate term basis is going to look. What are the opposition threats that are prevalent in the country? And then you have the whole Chinese, Russian, Iran undertones, if you will. One of the things that we've been talking about is, look, we've been paying way too much attention geopolitically. Been bringing it up occasionally over the last couple of years on BDE and I've always drawn the parallel between what Russia tried to do in the early '60s with Cuba and the Cuban Missile Crisis. It's a little bit more clandestine, it feels like, but our adversaries have been looking at Venezuela for a long period of time, particularly since Maduro took over. This is a vacuum they're rushing to fill. And so what is the stability threat that comes from those things that are on the ground, not to mention the cartels and the narco and the narco terrorists?
And they're already there. China and Russia are already there to help fill that vacuum. Right. And
growing their presence.
Yeah. So I think one of the things something you said jogged my aged memory. But in 1998, when oil prices were going to be low forever,
drowning in oil,
there was this whole notion of an OPEC war around market share. And Iran was going to go from, 4 to 6 million barrels a day or whatever the number was. And you had all these oil ministers negotiating against themselves in public. It was kind of madness. And then the Venezuelans couldn't stop. I don't know if you remember, but they're going to grow to 4 and then to 6 million barrels a day. And why do I bring that up? Because that was when they had technical prowess, right? They had Marathon, Lagavin, Corporavin were real companies. La Patura had happened. They had foreign investment. Nobody believed they could get to those numbers then. With that kind of structure. So again, they'll grow production if they get investment, they get their act in mind. But this isn't a massive wave of oil that's going to come out of Venezuela. It's going to take time.
And again, a big important element of how this all works going forward, you're going to have a meaningful, if not dominant, NOC presence in the form of PDVSA or whatever the next generation of PDVSA looks like. But it takes time to rebuild that capability as an organization for things to run somewhat smoothly, which they haven't been under, the Chavez version of PDVSA has become.
Right. Well, you have to have all the things we've talked about, and then you actually have to have service infrastructure. There's a lot that has to happen to get to a point where you can invest you can implement real projects.
And given a ready playing field, I think the industry has proven time and again, it's hard to bet against it from technical prowess and an execution standpoint. It's like Aubrey said back in 2012, I brought this up recently, when he said in front of the IPAA, we did our jobs too well in gas. We're going to do the same thing in oil. And I had a bit of a hesitation of some skepticism here, and we damn sure did it. So we can do it. It's just that the table's got to be set much more than we're currently dealing with in a lot of dimensions, not the least of which are above ground. I mean, multinationals are, at least Western multinationals are, and I'm speaking of China on the opposite end of that spectrum, are not going to immediately expose their personnel to a very unpredictable and opaque security situation. That's not going to happen. I mean, using what's happened in the Congo with the golden lane of cobalt, we haven't had a U.S. mining interest in the DRC since 2005, 2006. And 15 of the 16 foreign mining interests that are operating there that are dominant are Chinese based. And so we go at this much more deliberately for a lot of reasons, politically, security, et cetera. So that has to get sorted out before there's any meaningful scale of, you got to have a lot of boots on the ground there to make this very, very complex and capital intensive infrastructure repair and rebuild happen. And then we can talk about, kind of refining and upgrading the sophistication of, all the stuff that needs to go on to make the reservoir produce better, starting with, a pretty problematic hand that you've been dealt just because of the nature of the reservoir and the crude itself. So again, this is not turn on the spigots.
No, it's not. I do think, and again, one of the things people won't see, but will happen, right? The Venezuelans have been watching, the folks who have left the country, they've been watching
a third of the country, 8 million people.
They've been watching this pretty closely. Those technical people will, when things get better, they're probably the first ones to go back because they're proud, they love their country. You'll see those folks return as soon as things get. That's the first order of stability, and there won't be a press release about that, but there'll be some anecdotal evidence around folks going back where it's safe enough. They feel like they're safe. It's safe, and there's enough opportunity. They'll go back and try to help rebuild.
Yeah, they're in the kind of the upper quartile of the economic strata, and so most of the voluntary departures over time under Chavez and Maduro have been because they could leave. Right. So one of the things, and I'll ask if you've got any fun anecdotes from your time dealing with Venezuela, but one of the things that I think, just continues to exacerbate the problem, and I was watching the coverage over the weekend, is we've got this breathless commentary, and it was actually on Fox, of here's Venezuela's 303 billion barrels. And the comparative that they use for the U.S. was our 375 million barrels in the SPR. It was almost as bad as back in the day when Canadian gas was all the rage, late 90s, early 2000s. Bill O'Reilly was talking about Canadian gas reserves, but you could tell because he was calling them gasoline reserves.
Right. Oh, I remember that. That was
like the remedial level of understanding in the people who matter, which is the electorate, is still breathtaking. And the media continues to compound the ignorance by, just these fallacious and fantastical benchmarks or comparisons. People just don't understand how this industry works. And I think it's very important as we kind of march through the rest of this year. I can see it where, when, we're not showing meaningful Venezuelan production growth before the midterms, the companies themselves that essentially Trump has called out, the Exxons and the Chevrons and the ConocoPhillips of the world, their kind of responsive reality is not going to match with, let's go get after it right away. We're going to go drill a bunch of wells. Well, as you pointed out, it isn't about drilling a bunch of wells. It's a bunch of really kind of reconstruction and maintenance type of stuff that is just not inherently, quick to turn around.
Yeah, I do. I've got this anecdote, but it's not necessarily Venezuela, but it's around global reserves. And you've just got to be really careful. Again, you've got pundits who are talking about an industry they know nothing about, and they're taking numbers that are on a page somewhere. And so this is how long ago it was. Secretary of Energy Richardson, Bill Richardson, governor of New Mexico. He was, I guess, Clinton's Secretary of Energy. Anyway, he called a conference in Madrid for petroleum data quality. And I was asked to go speak. And so there were 5 of us who got up there, and there, I don't know, maybe 60 or 70 people here at this little junta to talk about how we need to improve data quality. And all of us had some level of a list of things, but the commonality was we need better data out of OPEC and Saudi. We need better reserve numbers. We need better production numbers, et cetera. And there was a guy who was sitting next to me, and I can't remember his name, but he had this really expensive suit, a very polished guy. His business card said advisor to oil minister Naimi, Ali al-Naimi. I was like, oh, that's a cool business card, by the way. And he got up after 5 of us spoke, and he very politely said, I'll paraphrase, you're wasting oxygen. The Kingdom of Saudi Arabia is not going to provide you that information. He said, well, let me restate that. If the U.S. government provides the Kingdom of Saudi Arabia with the locations of your missile silos in Kansas, we will then provide that information to you. And I thought it was fascinating. The room laughed, and I thought that is a very profound statement, which is our production capacity and our reserves are a strategic advantage for Saudi Arabia. And as long as the world, my view, as long as the world thinks they can increase production, they are strategically important. When there's a problem, call Saudi, they'll increase production and keep oil from going to 150 or 200. As soon as the world believes they're out of excess capacity, they're just a big oil producer. They lose their strategic relevance. And I thought that was really important. So the numbers you're going to get out of Saudi are wrong. They're not going to provide those numbers. Are they too high or too low? I don't know, but they're not right. And so it's hard to compare the Venezuelan numbers, which are a resource number, with a reserve number, with a strategic petroleum reserve
capacity
number
as well.
Production capacity. It's absolutely ridiculous. And if you go back, and it's hard to know. So in the U.S. on the gas side in 1998, the U.S. government, the EIA, published reports on their natural gas annual that said there was 15 billion cubic feet a day of excess capacity in U.S. natural gas supply, at a time when we only produced like 60. So we had 25% excess capacity. In a year and a half, gas prices were $10 because guess what? There was no excess capacity. People were producing it at full out.
Pre-shale too.
Pre-shale. And so you just, the data is a quagmire, and you just got to be really careful about about chrome plating stuff that's not worth chrome plating.
And I think the conclusion or the verdict is still split on when and where and how much on the Permian. And so is there an overconfidence that is prevalent in the market that the Permian is going to be able to respond as it has to fill the gap, fill the wedge?
Yeah, Permian will grow, but it's not going to grow at the million, or what's the growth rate been, 1.2 million barrels a day per year? No chance. I just don't believe it.
And that million two is not going to come in the near future from Venezuela, is the point.
It absolutely not. You're right.
Right. So I thought the anecdote was going to be the resource triangle anecdote.
Yeah.
But we'll save that for another one.
Yeah. I actually, I use that when I teach, because I think it's a really important concept on why are we focused on these kind of low end resources. It's because the high end stuff there's resource depletion going on on the high end of the conventional high quality stuff. And Venezuela is a classic example of going to the lower quality stuff.
So I guess you're back teaching now. This is your third semester back teaching. Pretty wide spectrum. You started off with the capstone course where you think last spring, where you kind of think about that as this more sophisticated kind of field study type of exercise for students that are literally about to walk out the door into their first jobs, hopefully.
Yeah.
And then last semester you taught well testing.
Well testing.
Yeah. And now you're back to capstone.
Back to capstone. And it's interesting because the capstone we didn't have the capstone. So the semester you graduate, you take this projects course. And it's really, for the students, it's the first time they've actually had to exercise engineering judgment. Because that's not the way the undergraduate engineering curriculums are designed. It's you do a task, here's the answer. You do a task, here's the answer. The fact that they don't have enough data, well, you have all the data, but it's not enough. It's like, no, you have all the data. And then 2 weeks later, they're like, well, this data conflicts. It's like, wait a minute, you just told me you didn't have enough data. Now you're telling me you have too much. Figure it out. And so it's a fun class to teach because you get to answer questions with a question. What do you think? And they're not used to that because that's not the playbook. That's not the playbook of an undergraduate engineering curriculum. So that's fun. Now well testing was really fun because it expanded from when we took it, because you have to start to talk about rate transient and unconventional. And we spent about 3 or 4 weeks on that. And that was really fun. It reminded me how much calculus I'd forgotten over the years, but it was
not
good
as much as I've forgotten. I can assure you.
It was good to get back in the saddle. And that was really fun because I think that's that's the core reservoir engineering class. If you understand well testing, you'll be a really good reservoir engineer. And so that was fun. I'm looking forward to the capstone here.
Well, I think that's a great capper, and we'll reserve the right to impose on you throughout what promises to be a macro and geopolitical and even technically rich year ahead for a lot of our content. I appreciate you doing this. And
that was fun. Thanks.
Welcome back anytime. So thanks everybody on Collide. If you like the piece, please share it with your friends. We'll have it out in companion with or shortly after we cut our live BDE tomorrow. I'm sure we'll be covering some of this topic, but the last 12 months has been interesting to say the least. So
yes.
See you guys next time. Again, thanks, Dave. And
thank you.
We'll cut it off there. Thanks.